mentioned gold hitting all-time highs. What about interest rates? They keep saying we're gonna cut, but they never end up cutting. Do you think they will cut, or do you think they're gonna go to stagflation where they actually, let's say, bump up the interest rates to 20%, and then suddenly that's how everyone gets bankrupted or defaulted on their mortgage, and then that's how they seize the mortgage instruments? Do you think that's a play, or do you think interest rates will go down, and when?
So the interest rate is a very interesting discussion. So interest rates, here's what's supposed to happen in the theory in a normal economic environment. We are in a recession. Quite clearly, we were in a recession from October 2023 when we met the criteria for a recession. But Janet Yellen said, no, it's not a recession because the labor market's so strong. Today, we had it confirmed, non-farm payroll numbers and the birth-death model and a whole bunch of things. They've cleaned out 818,000 jobs that were supposedly added in the new year weren't jobs. It was a statistic that they used to estimate that would bring in those, that we got new jobs, and there wasn't actually a Joe Schmo who got hired and started paying a check. In the end, what you end up with is this is a new debt instrument because that money comes from there somewhere. The government borrows it into existence and it gives it to its fellow cartel thieves, the banks, the investment banks. But they recognize that there's a huge amount of it coming. So the primary dealers have to sell it out to pension funds and other places. Where they can't sell it off, they have to hold on to it. So what do? They go borrow in Japan super cheap, and they buy that same debt leveraged, and they earn 4 or 5% recently, even 5.5%, and they pay 0.1. Well, that recently just went up to 0.25, never mind the margin that you have to put on top of that, at the same time as the economy is turning down and you have cuts. So suddenly you have a major risk-off event, money coming out the stock market, everything going for Dougal, everyone getting super scared. So we had a 40-year bull market where debt just became more valuable, we borrowed more into existence, etc., etc. That could have been on a yen trade following the 80s. Don't forget, Japan crashed in the 80s with their debt binge. Since then, they've had super low interest rates. That coincides with the 40-year from the 80s to today, where everybody has borrowed cheap. These banks, the American banks, could have gouged and gorged themselves full on cheap JPY debt and been investing in the stock markets, in buying the Fed's debt, etc. Eventually, the piper has to be paid. You could have a second leg sell-off in the USD JPY, and you can actually have a shortage of yen for servicing the interest payments that will be needed on the huge borrowing that a couple of major institutional banks like JP Morgan, Goldman Sachs might have made on the carry trade. So we don't know how deep the carry trade truly runs. It could go derivative deep, which means big problems for the dollar when they have to pay it back. So rates should spike, I feel, for debt to collapse, because there is a relationship like a seesaw. Higher rates, lower valuation. The truth is, too much of it means valuation go down. That should mean rates go up. We're in a recession. They've destroyed the consumer. There's two economies. So it's like a balloon that you've twisted and you've deflated the one half. Mm-hmm. We live in the part that's being deflated. The billionaire class have borrowed cheap, bought assets that have gone up and kept their rates. Properties have gone up, farmlands have gone up, everything's gone up. Any business that's still functioning well and creates dividends has gone up. Dark state, Magnificent Seven, has received a huge amount of government money. Much of it they borrowed because of tax. So rates should be going up. But we're in a recession at the consumer and retail level, that small part of the balloon that's twisted and separate to the big status part of the balloon. So with that understanding, it's hard for them to cut rates, but it's also hard for them to raise rates. So eventually there might be some cuts just because consumer is so wrecked, it'll eventually affect the other half of the balloon, because Amazon obviously can't stay highly valued if everyone stops buying on Amazon. So eventually the contagion does get to the billionaire class half, but they don't get it half as bad. So we're going to get some cuts. I think it's possible, but it'll be much less than most people think. We're probably going to get a crisis that's going to create a huge amount of economic activity, and war is perfect for that. But so's a pandemic, subsequent Mark II, version 2, any form of, you name it, manufactured event that isn't necessary, that will create proliferation, quantitative easing again. And then I'm expecting a fall in the value of oil, because that's everything inflation. And we're watching it get very weak on a HVF setup. So with that coming down, a big sell-off in oil, the inflation number goes down. They can justify some cuts, but they'll never get back to where they were at 2020. And then the rebound will take us even higher on interest rates. So it literally is like an ABC. Up in rates, then a correction down, which we might be in now, maybe a little event, spills a little further than we think, and then in the next surge, when they proliferate money again, which they invariably do. It's the only tool in their box. So I don't know if that gives you some color to your question.